third episode, but the initial episode of the Canadian Investors podcast. Cool. Featuring Nate. You want to introduce yourself?
All right. Well, welcome to the third episode of the Canadian Investor podcast. I am going to be hosting today's episode. I'm Nate. I am a school teacher by trade. I have no formal training in investments, but I really like stocks and talking about stocks. And I tend to have a bit of a quantitative bias, and you'll definitely see that in my analysis today. I run another website that's on, actually I run two other websites that are on statistical analysis. So that's really my focus in investments. And I like to remove the narratives around stocks out, which I think makes me very different from everyone else in this group, because I don't trust myself not to be biased, and I don't trust other people not to be biased. So my goal is always to be as unbiased as possible by looking at the numbers as much as possible. Before I get into like my introduction to our stock, today we're going to be talking about Facebook stock, which I'm actually really excited about. Kun and Tom, do you want to introduce yourselves?
Sure. My name is Kun Ho. I'm a university professor teaching at University of West Ontario. I teach financial accounting and management accounting, so I'm a CPA by trade. My investment philosophy is actually, now we heard Nate's, is quite different. Even though I have a technical training, I kind of use my accounting knowledge to kind of test whether the narrative or the story of the company is true. I tend to go for mostly kind of long-term compounders, and sometimes the company is not going to be very profitable for a long time. I'm happy holding those, but it's important to understand what the company is reporting. So I try to use some of my knowledge to make sure that the story is still on track.
Tom?
Yeah, my name is Tom. I am just a regular guy. I've always worried about my retirement, and it caused me a long time ago to start looking into actually what it takes to become financially free. And I've spent, just hundreds of hours reading books, doing research all on my own to try and figure this out. I'm not an expert. I just am always learning, trying to figure out the best way that I'm going to become financially free. I don't think there's any right or wrong way. Everybody has different strategies, and a lot of these different strategies work. I tend to focus a lot more on, I'd like the qualitative and the quantitative, but I think that in order for you to hold on to a stock through the small dips and negativity, you have to have a story. You have to really believe in that business, and you have to really understand the business to know if this is a short-term problem or a long-term problem. Because, in the markets, we're always confronted with all of this noise about, oh my God, this is going to happen, that's going to happen. And you got to really believe in the business if you're going to be able to hold through the downturns. I think it was I can't remember if it was like Amazon, who's had 9, 20% or 30% drops throughout its rise to the top. And it's like, if you would have sold, oh my God, I lost 30%, you would have missed out on all of those gains. But you got to really understand and believe in the business to be able to stomach the downturns.
Yeah, I agree with you. Although I definitely spend less time analyzing the qualitative. Actually, I really like when you analyze qualitatively a stock and then pass it on to me, because then I analyze it my way, and then if it passes both your way and my way, I get really excited. But I think I like to pick stocks that I already know have moats, and then try and find the best ones from a quantitative standpoint. But I don't tend to obsess over the moats. So I'm going to talk about Facebook now. I'll be really quick in it, talking about what it does, because everybody knows what it is. It's a social media company. And what they do, their main source of revenue is through advertising. And I think they get a bad rap because they use people's personal data to power that advertising, so that advertisers can make really specific choices in how they advertise. Now, full disclosure, I have my own side business. It's not very profitable. It's a small side hustle, but we use Facebook advertising, and it's really, I don't think it's actually as interesting as people believe. It's based on people's what you put in your profile data. So I have an education business, and when I run an ad, I just type in teachers in such and such countries, And then Facebook sends my ads out to all teachers in that country, which is like super useful. As someone who has an education business, specifically like a very niche education business, my company would not succeed advertising to everybody. So I kind of need that Facebook infrastructure to make my company succeed. And this is something like Mark Zuckerberg himself has talked about a lot, is that most of the people marketing on his platform are actually small business owners, which makes complete sense to me. I think they are undervalued at this moment, very obviously, and I'll get into a why and how, and I think they're actually extremely undervalued personally. And I think before we look at that though, I think we need to understand the philosophy of value investing. And I'll just really quickly touch on that. There's value investing on average outperforms other forms of investing. And there's theories as to why it does. The most common theory is the reversion to the mean theory, that when stocks go down, they typically go down and then up, and that things tend to normalize over time. So if you buy a stock that's at all-time highs, that you're likely to not benefit. If you buy a stock that's underperforming its past performance, then you're likely to benefit. Another theory as to why value investing works is that you're taking on increased risk exposure. And I think both theories can actually be true, but not all the time. So for example, like Canadian bank stocks are super cheap and they pay really high dividends and they have really high moats, but they don't tend to show a lot of growth. So I actually think in that case, you're not taking on more risk and you're not using a reversion of the mean strategy, but you're still using value investing principles. But I think in the case of Facebook, you are taking on additional risk and you are hoping it reverts to the mean. And I think the big risk concern right now is kind of qualitative in the fact that Facebook is a social media company and social media users tend to be fickle. People worry that, it's going to be another MySpace, for example. For those kids watching the podcast, I don't remember. MySpace was a social media platform that used to exist and then just completely died. And right now, like for the first time ever, the daily average users of Facebook dropped. And they're
in North America.
In North America, sorry, thank you. And they're losing in terms of their competition to TikTok. I think we have to understand, just moving forward, that Facebook is a different company than it was 5 years ago. Like I think it was an extreme growth company a couple years ago. And I think now it's become kind of a utility. I would say it's like a utility company, just like the telephone service. Because as much as like TikTok and Facebook are both internet social media companies, I don't think they're directly comparable, because you don't really use TikTok to stay in touch with people. Facebook is a tool to stay in touch with people, to communicate with people, to form groups. So I met Tom and Kuhn both on Facebook in investment groups. And actually, I belong to a whole bunch of groups, and I use Facebook for marketing and to keep in touch with friends. I've traveled all around the world and have made friends in multiple different countries. And I use Facebook to keep in touch with all those friends.
Don't they have like 2-point-something billion users worldwide?
I think it's 3 billion, isn't it?
So I have the Facebook investor presentation up right now on my screen. Monthly active users.
I have
2.9
the share
billion
screen enabled. So if you want to go ahead, you can.
Okay. So I think the reality is like, there's not going to, I think it's unlikely that we'll see. So we saw a very slight drop in users on a daily basis. And I think that's a representation of people not being as entertained by Facebook. And, but I think the reality is that Facebook isn't really competing with TikTok in the way that people think. You're not going to, people didn't stop using the telephone because Facebook was invented.
So sorry for interrupting
yeah.
you. So this is a kind of key insight, right? And I want to challenge it a little bit, because on the investor call, didn't Mark Zuckerberg specifically mention that, hey, we're going to go after the 19 to 29-year-olds, and we're going to use Reels, and the Reels is like the direct competitor to TikTok, hoping to gain those customers back. And they say, well, we're not focused on the older demographic as much. Do you think he's sandbagging? Like he's not like revealing his cards?
No, I think the reality is that he wants to stay being a growth company. So Mark Zuckerberg wants Facebook to be a growth company because that's where it's made a lot of its share price in the past. And it stopped being a growth company because it's become a utility company that, most people our age feel we need in our life, that we use on a daily basis or at least a monthly basis to stay in touch with people. And TikTok isn't that. TikTok is an entertainment thing. But the reality is that, like, young people don't use Facebook. So I'm a school teacher and I see it. Nobody under the age of 20 is using Facebook. They will tell you in class that Facebook is for your grandma. But I don't think people in my generation are going to stop using Facebook. No. And in some ways I see more and more older people joining Facebook. And you also see increased use.
Well, yeah, I'm one of those. I had an account for almost 10 years, didn't bother with it. And once I started, getting really serious with the investment, and I was attracted to these groups, and found like-minded individuals. So, I'm a perfect example of that.
Yeah, and my father-in-law, like, he's into photography. He just joined Facebook just to join photography groups. And I think you're going to see an increase of that. That's why I think Facebook isn't going anywhere anytime soon. I think 60 years from now, it might really disappear, because I think if young people don't join Facebook, it is going to have a long-term problem. But I don't think that's a 5-year problem or a 10-year problem. I think that's more like a 25, 30, 40, 50-year problem.
So what do you think the bear thesis? And what you just mentioned, like, we're all three of us are long Facebook, right? But we're long before the crash.
I was. I bought in at 345, so I've lost a lot.
Yeah, the key criticism was that, hey, look at the U.S. and Canadian users; they account for over half of the revenue. So, like, they are way more profitable than any other user groups, in the world, and we're plateauing, right? So, is this basically, do you think we're plateauing on a flat line, or do you think we're going to
I think it's going to mostly plateau, but in terms of users, but I think there's two things that are positive. I think, I see more people joining from Africa onto Facebook. And I think that we might see increased older people joining in on Facebook too. As people, if it becomes more apparent that it's a utility, no different than your telephone. But I think there's also the metaverse possibility. So they're investing really heavily in the metaverse, and Tom is really excited about the metaverse. I'm not actually. My valuation of Facebook is completely ignoring the metaverse, because I don't actually think it needs the metaverse to succeed as a company. I think it's really cool if it does, though. I think if it does, it's almost like a lottery ticket. I think the stock is going to really take off. But I don't think I think the stock is so cheap now and so undervalued that it doesn't matter if Meta takes off.
So I'd like to jump in for a second.
Go
as per like a lot of the bear case in people saying, okay, their monthly active users or daily active users has plateaued. Like, they have almost 3 billion. They've got like almost half the planet. On the platform. So, like, how much do you really expect user growth? Like, I think there becomes a point where you're on Facebook, you're not.
Yeah, and it's banned in China, so they're really kind of like they got like more than half of the actual eligible users.
That's a really good point. And like, just a side tangent, sorry to interrupt, Tom, is like, as someone who advertises on Facebook, I've noticed that my ads are way more successful than they are in Africa than they are in Canada and the United States. And I actually sometimes specifically target Africa with advertising because of the fact that I think Facebook is more novel there, and people are more new to Facebook. So they don't have that novelty effect. Like, when you see an ad on Facebook, as like Tom and I probably, who've used it more frequently, you probably immediately gloss over it. And there's research showing that as soon as you know something's an ad, you stop looking. Whereas like people who are less familiar tend to not gloss over it. So the fact that my advertising is so much more effective in Africa tells me that like it's newer there and it's more novel. Sorry, Tom.
Yeah, there's definitely some growth for the rest of the world. But I think what a lot of people, especially the bears, are ignoring is that Facebook has control of the frequency of ads, right? So you don't need to necessarily have more users to increase revenues and income at a growth rate of like 10% plus. Is the frequency of ads and the quality of ads. Because like a lot of people don't realize, and I think Facebook has a messaging problem, especially like from what I've been reading in Europe and the data privacy and stuff like that, is people think that Facebook is selling your data to somebody else, and that other third party can have access to the data and know who you are, right? When it's it's just misunderstood in general about how they're selling data and how they're using the data to give you more customized advertisement. So I had a conversation with someone, just a random person. They were talking about the Apple updates and how they didn't want their data to be used by Facebook. And I said, well, can I ask you this? I say, so you don't want your data and now you have uncustomized ads. I say, how do you feel about that small business owner who is local in your area that wants to find customers local in their area? Like Facebook, what they've done is they've leveled the playing field and given the small business a chance to interact with potential clients. And this was really only available to people with high budgets before, right?
Yeah.
Like if you have like a small little pizza store and you don't want half the city to see your advertising, because most of those people are never going to be in your neighborhood, right? So you being able to target by geography, when if you had a bus bench or a commercial or a newspaper advertisement, most of the people that see that aren't actually customers. So you're wasting a lot of your advertising dollars. And you know, I've run ad campaigns in the past through Facebook where you can spend $30 a day, $20 a day and see real results. And you're not going to get that kind of exposure through commercials, or, you know, because it costs a lot of money to develop a commercial or even a radio commercial and have it run all the time. So I think that the way Facebook has tried to sort of hide, like in the past, hide how they target people, I think that they need to be more open on who this is helping, because the messaging is that, oh, this huge corporation is selling our data and making all of this money off of our data, when in reality what's happening is Facebook is enabling small businesses to have the same type of ad dollars impact as the big corporations previously had.
Okay, on that point, Tom and Nate,
I agree.
I mean, for the people, like, you know, I haven't done advertising campaigns, so I get that Google Communities is aiming for the same
but like, does Google
customer
Community
base,
have
so
the same network effect? Because I just feel like the main advantage to Facebook is the network effect.
Yeah,
right, which is kind of like they're trying to walk this line, right? So you guys talked about you can introduce increase the frequency of ad, which actually might, you know, then annoy some users, would drive some away. You know, we don't have data.
I don't even think that most users even notice that they are ads. Just
if you have to flip through more things on your phone, that the more kind of, you know, appealing it gets, right? So at least that's a theory. You know, for me, that's not going to deter me from being a Facebook user, but at least I heard that, you know, someone is annoyed by that. And the second is, okay, so then if you have the less ability to target, because of the Apple privacy block, they're going to be more incentivized to use Google, right? And I get that, you know, Google doesn't have the network effect as Facebook, but I guess, you know, that's what a real concern that leading to the stock dropping so much.
So I think actually that's a misunderstanding of how this is working. So the main way that Facebook ads work is based off of things you put in your profile. So when you say, like, I'm a professor and an accountant, when I run an ad, I look for the occupation of the person. And it's not working based off cookies. So the ads are not going to become less targeted. What's going to change is the results of the ads. So right now, when I run an ad, I can see exactly how many people clicked on it, what gender they were, how old they were, and I can break it down against demographics, what country they're from. That might disappear, that type of knowledge and information, as cookies are disenabled.
Okay, so that's what Stanberg was saying about measurement. Like, they had the measurement issue. Yeah,
that's exactly it. So the measurement will change. This is already a problem with Apple. So like, iPhone users are already blocking this type of data. So like, I run a podcast, and since that update at Apple has come through, I have less insight into how many listeners I have a month. Because if you're on an iPhone and you're listening to my podcast and you click the block cookies thing or the block tracking, I no longer get to see if you're listening to my podcast and how many people use iPhones, right? So it's really more that you're going in blind, and you're not, when you pay for something, you don't know what you're getting. But I don't think this is an advantage for Google per se, in the sense for advertising, because Google still isn't going to be more targeted. It's the real advantage of Facebook advertising is how targeted it is. And Facebook ads are like super targeted. And that's not going to change. You're just not going to know how well they're going to do.
Yeah, I agree.
So sorry for bringing this up. I think, like we were, Tom was probably looking for it. And this goes back to what we're saying about the profitability per user, right? And one thing I guess, this slide is not showing is that in the US and Canada, we have way more iPhone users than the rest of the world. I know that for a fact.
Yeah.
Right.
Oh,
so the growth areas, the Europeans, they're way more comfortable with Android, and you're talking about Africa. I doubt that the penetration in Africa for iPhones is that high.
No, the funny thing, sorry, it's just a quick side tangent. If you look at like the actual specs on phones, what you pay dollar for dollar if you buy not Apple, you get way higher quality if you don't buy Apple, because Apple is selling you the same product at like double the price. So
you're buying into the ecosystem.
Exactly. You're not, and you're buying. I think the real reason people buy iPhones is for the fashion statement. So they have that little apple on the back of their phone. So I kind of, if you guys do, I really like to share my valuation with it, and why I think it's so extremely undervalued. Do you guys have something you want to say about the qualitative before I do that?
I just wanted to clarify on what Kun said about the Google versus Facebook advertising. So the thing is Google, because I used to run Google and Facebook ads simultaneously, and Google's more of like someone is looking for something, and you're catching them while they're looking for something. Facebook is more of a pushing in your face to notify you that this is available. When you might not necessarily be looking for it, but it is something that you might be likely to buy.
Yeah, and I also think Google's way more expensive.
Yeah.
So like I've looked into doing Google advertising, and it's way less successful to the average business person because it's so much more pricey. Like
interesting, even though it's growing 40% a year. Thanks for educating me on the difference in using ads. I had no idea. But okay, so given iPhone, Apple coming out with this policy, do you think Android might do something similar to basically cutting off Facebook's legs because they don't have their own hardware, gateway?
Like that's almost unquestionable, like for sure.
It's gonna happen.
Cookies are dead. Like we're not gonna have the same kind of like knowledge, and so like I think you do have to consider that, and I think part of my evaluation of Facebook is understanding the growth is going to slow, but they also got to think who's the competitor, like who are they going to go to? Like is everyone just going to stop using Facebook ads and go advertise on Google? I'm not. There's no way I would, because it's way cheaper on Facebook and it's more targeted on Facebook. And even if I don't have the results, I still know that I'm going to have my best advertising results from Facebook. So why would I just
need to stress like they're still the best platform, even though they don't get to see all those data that they used to have, right? Back to the 50% of the advertising works, you just don't know which half, kind of
exactly
paradigm.
Yeah, and I mean, think of it like the old paradigm too. Like when you ran a commercial on TV, you had no idea if that was succeeding or not, or if you ran an advertising on the radio, you had no idea. Short of like people coming into your business and buying a product, and you'll still see that. Like when I run a Facebook ad, I see increased sales on my website. Like but I think the real value of advertising is brand recognition. Actually, I don't think it's actually directly driving sales. Everyone knows that it's way cheaper to keep an existing customer than it is to make a new one. I don't think you typically, at least I've not found that you typically make your money back immediately upon advertising. It's more that you expand the future pool of revenue.
I think it depends on what type of product or service you're selling. Especially now that we've seen Facebook make relationships with like Shopify to be allowed to like sell stuff directly on Facebook in the same way Shopify does. It's just expanding its small and medium-sized business. And I think what a lot of people fail to recognize is the other bets that they have going on. Like the way they're going to be, like it was originally closer to the time when I first bought into Facebook is when they bought, I think, a 10% stake in Reliance Jio over in India. And what this does is is it opens them up to the Indian e-commerce, and they're going to be starting to try to monetize WhatsApp into a payment processor, right? So that people, because right now the WhatsApp is highest user in India. So imagine being able to send money and accept payments and stuff like that in India through WhatsApp. That small transaction fee is gonna number one, help drive future growth. So we got to look at the advertising business, and then you got to also figure, okay, what are these other businesses going to be worth in the future? A lot of people were saying, oh, that they were afraid that the government was going to break up Facebook. And I'm actually under the belief that the sum of the parts is greater than the whole in Facebook's in Facebook's case. Like if you look at, like, for example, the Oculus business, I think is growing at like close to 100% a year right now.
Makes
Like
sense.
what would a multiple be on a business that's growing 100%? Like if you look at a lot of those high multiple stocks, even though they're been cut off at the knees recently, a company growing at 100% deserves a pretty high, a much higher multiple on price to sales or expectations of future cash flows.
100% agree. And this is part of what I'm going to talk about today too, is that you can't just look at like the Facebook business as a whole and be like, growth is going to stop, because growth has not stopped. And like growth has like been so high in the past. So I'm just going to break down some of their financials real quick.
Do you mind just kind of expanding the column A so we can see everything?
You can't see column
the
A.
width.
The widths, yeah.
I don't know how
No,
to
just
do
making sure you
just double click on the right side of the, move your mouse to the right.
Yeah, just because
like
the contents is longer than the cell itself, right?
No, just widen the cell.
Yeah.
Widen out. How do I widen out? Like zoom out?
No. Like you click in between
On the margin.
A and B cell, in between A and B cell on the click
Yeah,
there.
yeah.
No,
Go up.
Click.
Okay, we'll edit this part out. Yeah, okay. Yeah, there you
Oh,
go.
I see what you're saying.
Yeah.
Yeah.
Did you see it any better now?
Oh yeah,
that's better.
Yeah.
Usually if you double click it, it'll automatically go to the right width.
Oh, okay. My apologies. I didn't know that actually. Okay, so looking at the trailing PE, it's 14.97. Compared to the S&P right now, the average stock in the S&P 500 is 19.69. So I really want to draw attention to this fact here alone. So the average company in the S&P 500 is trading at way more expensive than Facebook, when Facebook is one of the greatest companies in the world for its revenue streams and growth. So to me, it doesn't.
Is this equal weight or market cap based, that calculation? I've never really.
I don't know, actually. I think it's the average. If you just look up on, say, Y charts, what the average PE of the S&P 500 is. I'm assuming it's equal weight, but maybe it's not.
Okay.
I would assume it'd have to be. I don't know how you could calculate it with not, because my assumption would be that they take all the companies and then just take the average, because that's probably the easiest way of doing it.
Right.
So and then you look at the S&P historically over the last 100 years, it sits around 13. So if we look at that, it looks slightly overvalued, but I don't think we should compare Facebook to the average company in the S&P over the last 100 years. And if you look at like over the last 10 to 20 years, the S&P has been sitting around 20. So actually, I think the S&P might be potentially on a lower valuation right now, although that's obviously being dropped because people are worried about interest rates. But part of, I think, the fear of interest rates is obviously how it affects DCFs, but it's also obviously how it affects companies with higher debts. And Facebook just has so little debt. Facebook's debt to equity ratio is 0.27. And to be fair, any stock below 1 is considered healthy, and it's considered within reason to get up to a debt to equity below 2. So like 0.27 is nothing for debt to equity. So the 5-year average of the S&P 5-year average PE of Facebook is 29.45, and the industry average right now is 30. So like, it looks to me like it's basically at 50% of what was a roughly fair value.
Who are the peers? Like, where did you get this peer?
I get the other FANG stocks right there.
The other things, okay.
Yeah, so it's
yeah, Netflix and Amazon will drag it up by significantly. Yeah, but Microsoft is over 30, I think. But
but even like Apple, Microsoft, these are all really high flying tech stocks. They're all trading way higher than Facebook. And like realistically, this type of valuation, like a P 14.97 times the earnings, is a value stock, a traditional value stock P. Like I'm willing to pay a premium for a high growth company like Facebook. Like a company with like the margins and the success rate of Facebook, I'd be willing to pay a higher PE. And in fact, I know that because I bought it at PE 25 and it's now 14.97. And that's mostly because it's gone down in value. But you know, when a company is earning more profits and it's increasing its profits faster, it's worth a higher multiple. I'm being worth basically what an average value stock or quote unquote value stock is worth, I think is crazy. Like I think it's dirt cheap. So part of it, this is based off growth though, obviously, right? So like if we, and actually I'll take a second here. Like look, this is a graph and it shows the PEs of some common value stocks or stocks that people claim are value stocks. It's like Costco's trading at 44, PG, Procter & Gamble's trading at 28, TELUS is trading at 26. By the way, can't stand TELUS as a stock, but that's a side tangent. Johnson & Johnson is trading at 20 times. And this is my favorite one to point out, BCE, Bell. Like if you're a Canadian investor, Bell is always advertised as like the best utility value stock to be invested in because it has to pay roughly a 5 to 6% dividend usually. And it's just been so stable. But BCE or Bell is trading at 20 times earnings. Like Facebook is so much cheaper than Bell. And Bell has grown on average 1% per year in terms of profit. So that really means that Bell is growing slower than inflation, which really means Bell's in terms of real value in dollars is actually shrinking as a company. Whereas Facebook has actually been growing still quite a bit. So like, you have to ask yourself, like if you could own Bell for 20 times earnings, why would you not want Facebook at 14? Like that to me, it just says everything. Like Facebook is so much cheaper than Bell. And I think Facebook is such a better company than Bell.
Wow. Okay. So there's a couple of things. So, you know, we, much of the modern, lots of growth coming from the software companies, they all have the same issue, right? So it's boom or bust. And I don't mean, you know, I don't mean whether they're, you know, having tons of cash or no cash, but in terms of, you know, you guys talked about the moat being network effects, and a lot of these the investments are sunk, right? So you know, it's often two platforms competing or three platforms competing for the same target, and whoever gets there first wins the entire thing. So, and you're not going to put a lot of value on the assets because those are intangible assets. Now, for a company like Bell, it's not like to say there are no intangible assets. They do. They have the cable networks and they have the television, but a lot of it's the brick and mortar. They have obviously the infrastructure.
Yeah.
So those are much harder to replace, and those are not a zero-sum game, right? Because if they want to sell to Rogers or TELUS, they could. I mean, the government now let them. But anyways, I agree with you in terms of Facebook's being undervalued compared to that. But the liquidation, if we do come to the point where the firm has to liquidate, that's where I think people, you know, don't place a lot of value in assets.
See, I agree with you, like the Bell is more stable than Facebook, but I also feel like they're both at this point realistically utilities. Like I don't see Facebook as like a super growth stock anymore. I think it is a growth stock still, but I think it's not it's more of a utility than anything. So when I think like, would I rather buy Facebook at 14 or Bell at 20? When I look at the growth rates of these companies, yeah, I think Bell is more safe, and that's why it's got that premium. But I argue that Facebook is just so much cheaper and such a better company.
Yeah, I'd also like to bring up, you know, I know Nate likes to talk a lot about PE, and I hate PE as a metric. And
free cash flow.
Yeah, like I like to look at, so one of the things I look at for in businesses that I find very different, like if you're going to compare Bell to Facebook, is when you have a founder run company, right? The decisions of where they spend money is different, right? So when you have a CEO that has a compensation structure based on earnings per share, they're gonna spend in ways to drive up EPS. But when you have a company like Meta, for example, I've got their financial statements from their latest quarter. Their net income was $10 billion, right? and their research and development was $7 billion. Like they could easily spend $3 billion on R&D, and their net income would rise by 50% in a snap of a finger with no additional revenue, right?
Yeah. Or they could pay that out as a dividend if they wanted.
Or they could pay that out as a dividend. But when you have founder-run companies, and this is why I hate PEs, because they're spending for future growth and they're investing and building that moat, and it can be deceiving to look at just the earnings as relative to the total value of the company. Just like when you were talking about Ford, when we were having a conversation about Ford and the other the EV revolution, is these companies are going to have to spend a lot of money, and when you spend that kind of money, it changes the whole PE. And I like to look at it from a more like the business as a whole, and say, okay, did they choose to spend $7 billion on R&D? Like, so they've intentionally made their earnings lower.
Yeah.
Right.
But I actually kind of address that. So I point out that on average, they're spending about 20% of their earnings on research and development. And I actually think that's great. And I think that's part of what's driving their growth as a company. And I'm sure that part of what's driving their growth of the company is not actually just user data. And I think that's what people are missing, is they're so focused on how many users Facebook has. I'm sure that part of what Facebook's doing as a company is that they're focusing on how do we monetize the users we do have better. And you see that, like last year, despite the fact that they didn't have significant user growth, we had an earnings growth rate of 27% while they were spending billions and billions of dollars on research and development. So like, and then the revenue growth last year was 28%. So like we saw the stock price drop like 25% within the last like week, basically, or 2 weeks.
Your number is incorrect, Nate.
What do you have as a number?
Our R&D, I think when you say percent of profits for R&D, that's the percentage of revenue to R&D.
Oh, okay. I don't have it as profit. My apologies.
Yeah, because I'm looking here. Their revenue was 33 billion and their R&D was 7 billion, but their net income was 10 billion, which would make R&D like 70% of their like 70. It's closer to 70%.
So like let's say, so then like think of that for a second then, like the PE. So realistically, if they wanted to, they could drop that PE to way below 10. So
obviously, because these are not sustaining R&D, right? Because the R&D, we all know it's going to the metaverse, and Zuckerberg is driving that.
But not all of the
R&D have the 10 billion in R&D for the metaverse.
7 billion.
7? Okay, yeah, for the
7 billion.
Labs.
Like they could easily still spend 3 billion on R&D and drive up EPS by 50%.
So I got 22.6 billion for our R&D in the last trailing 12 months. And like that, when you think about that, it's obviously not all the metaverse. And then you look at like their R&D over time, they have consistently spent a lot of money on R&D. So I think that is because like the CEO, clearly Mark Zuckerberg, clearly wants to keep the company growing. I think he's clearly committed to the company. And I actually agree with Tom about the owner or the starter run business. But he's going to see this as personal. He's going to be more invested in the company. And he's shown a clear ability to execute. Like say what you will about Facebook. He's like, I really don't think the growth is going to go to zero overnight. Like the last 5-year growth rate, I think I have it on here.
Of what? I have ticker
on earnings. What is the last 5 years growth rate
for earnings?
Yeah.
Operating income. So last
probably in a 20 to 25% range.
I thought it was higher, to be honest.
Well, yeah, it's actually higher because in 17 it was 62%.
Yeah, I think that
so it was 23%, 16%, 12%, 43%. So I'm putting it around 30%.
Yeah. Okay.
Roughly.
I meant to have that included here, but I think that like that's when I don't think that growth rate is going to drop to zero or negative overnight because the daily active users went down. And something to keep in mind when we look at the daily active users metric, the monthly active users actually went up. So like people like really overreacted to this last quarter's news, I think. And I think that makes a huge potential profit on the table for people who are going to hold or buy. In fact, I doubled down. My original buy on this was at 345 because I thought it was undervalued, and then it dropped to like 245, and I bought a bunch more. Yeah.
Right.
So I think I have it here somewhere. Analyst predicted growth rate is 21.35% per year, which is pretty muted when you think that last year it grew at 27%. And I'm going to guess the growth rate is around 20% per year, but and that's partly looking at what the analysts are predicting, and also thinking about the fact that, yeah, I do think growth is going down, but I also think you can't ignore all past growth and just assume it's going to disappear. I think past growth indicates that the company is executing, especially when we show that the company's been executing over a long period of time. And something that Tom pointed out to me is the buybacks. Facebook is promising to buy back about 5% of shares per year. So that valuation is going to be dropping by about 5% per year. So I went down and I did some projections based off these numbers. And I did a couple of different models just to see like what that would look like. I'm just going to move this up for a second. So like if we have 20% growth plus 5% of buybacks, we get down to a PE within 10 years of 0.84. And that's not removing R&D. So then it reverted back to its PE of 30, you would make a 35-fold increased return on your money. If it reverted back to the S&P, you would get a 22-fold return. And if you got a reversion back to the 100-year average on the S&P, you would get a 15-fold return. Like that, and that's just on, when you consider that the company has been growing at around 30 to 40% on average, I don't think that's actually that bullish of an argument. I think that's a pretty moderate argument.
I think to the bear side of your argument right now is people are freaked out because Facebook guided at 10%.
Yeah.
Right. So if you're building 20% into your modeling, and now all of a sudden it's like Facebook itself is saying, hey, we're only expecting 10% growth for the first quarter. You're like, whoa, like cutting the growth rate in half significantly changes the valuation if you're projecting future cash flows.
Yeah, and I agree with that. And like I said, so I think this is probably my more moderate projection. And I still think we get a good, like, no matter what we look at, I think we get a good return on Facebook. Like, it's so dirt cheap right now, in my opinion, my unprofessional opinion, but I just don't understand how you get a bad return on Facebook. So like, look at like 10 years. So I put in 10% growth with 5% buybacks. Within 10 years, we're still at a PE of 2.94. Which gives us, if it reverts back to its PE of 30, which probably wouldn't do if this happens, to be fair, it gets a 10-fold return. I
have a hard time. Obviously, like I think you obviously know what you're doing, and you have this kind of like going to the future, but also looking at current PE. I did something similar. So, but it was free cash flows, and so this is going to be my
obviously the DCF right? is most people's model for doing this, right?
Yeah. So I can just set numbers because there's not a lot of calculations. So they made about 38 billion in free cash flow this year.
Yeah.
So if we assume 10% growth, which is low, but I'm just like that said, this is a low case. 10% growth in the free cash flow in 5 years, it's going to be 61 billion.
Yeah.
Right. And assigning a 15-time multiple to the free cash flow at 61 billion, it's going to be 915 billion. And if we just discount it back at 8% per year, we have 622 billion market cap. And today, actually, when I did it, it was actually higher. So today is probably at 520-ish billion. So I don't see in 5 years how I can lose money actually at the current stock price. But I think the upside is higher. But that's a back of envelope calculation.
Yeah, and I actually think that's great. I love Warren Buffett's quote on this. He says, "If your argument can't fit on the back of an envelope, it's wrong." And that's kind of my point here. Like, this is not like detailed financial analysis. This is just rough estimates. And even at zero growth with 5% buybacks, we still get to a PE of 8 within 10 years, 8.9, which if it were reverted back to its 300% mean would be tripling your money. And then if it reverted back to the average S&P price of like 19 right now, you double your money. And then if it reverted back to the even 13, you would make a 45% return. So like I see that as like the worst case scenario, like my most bear case scenario is it makes 45% return in 10 years.
So I think the key the things that investors are trying to come to grip with is, you know, it's both good and bad thing about Facebook. You talk about the founder-led growth. So Zuckerberg is clearly trying to steer the company back into the growth territory, right? With the metaverse bet.
Yeah.
So basically, you know, go back to the Bell argument. So like, you know, like a lot of indexes and pension fund would love to own Facebook if Facebook paid a dividend, right? Which they could. But what happens is that, okay, so they have this huge, and I was just looking again back at the investor deck, their margins are not in the investor deck. So this is just ticker terminals that they segmented out Reality Labs. The margins on their family apps business is over 50%, over 50.
Net margin.
So just remove some general admin fees. They can pay a very healthy dividend if they wanted to. But the company is obviously not steering in that direction, right? But Zuckerberg wants to make this even bigger with the metaverse bet. So then you have, you know, this 10 billion investment cost for the Reality Labs section. So basically, investors trying to come to grip with is that, okay, so the company is generating tons of cash, but that's not mine, right? Zuckerberg is spending it on his grand vision. How likely is he like to pull it off, right?
So Kun, I'd like to interrupt there. You know, I've seen this so many times where I'm not saying that you believe this, but a lot of newer and retail investors don't understand that buybacks are the same as dividends, except you can control when you're taxed on it, right? I was reading this book. I can't remember the name of the book, but you know, they were making a comparison of it was a book where we're analyzing all of the letters to shareholders from all of the great CEOs throughout history. And, you know, they were talking about that if I give you a dividend, then I'm forcing you to pay taxes on that money right now, right? So let's say if I give because Facebook's going to buy back 5% of the company. So that's pretty much like they have a 5% dividend, except if we were to give you that 5% in cash, then you have to now pay taxes on it. If they buy it back,
I agree.
And then you sell 5% of your shares each year. You would actually, in a lot of cases, have the capital gains rather than and you can control when you pay those taxes. So I prefer buybacks over dividends.
I actually like dividends, and I think it's kind of to the reason that Kuhn is kind of trying to suggest here, is that dividends are ultimately a risk management thing, because if you're paid actual physical cash for owning a company, and the company starts to have their share price go down, you still have that cash flow that you can rely on, and you know that your money's coming out. So like, let's say I have a company paying out an 8% dividend over time, and then I use that 8% dividend to go buy different companies. Well, I'm going to make a guaranteed compounding return on that stock over a 10-year period where I really almost can't lose money.
Buybacks are also discretionary, right? A lot more discretionary. So dividends usually, if company cut dividend, it's usually a very bad sign. So generally they don't do that. I think it's like must be 99% kind of retention rate in normal years. And anyways, I don't want to, you know, harp on this forever, but I think I agree with both of you. It's just you know, we have to understand the nuances.
Yeah,
I think I think that a lot of companies, once they start paying dividends, because they don't want to cut that dividend because of what it will do to the stock price, I think that puts a lot of companies in bad positions. And I've seen so many companies where, you know, these dividend aristocrats or dividend kings where they've been paying out a dividend, when I actually think, hey, it would probably be better for the long-term future of the business if you stop paying that dividend, paid down some debt, or put it into other places in the business that would sustain long-term growth and long-term stability in a much higher way, especially when some of these companies have like a year or two where they're not doing so well, but they keep paying out that dividend just for the sake of paying it out.
Yeah, I kind of see this as like, I really want to compare this to Algonquin Power. And I compared this to Bell earlier too, because I think they're both utility companies. And I think like Bell pays out that 5 to 6% dividend. So really similar to that 5% buyback, except Facebook grew 27% last year or something along those lines. And Bell grew 1%, which is when inflation's around 6%. So Bell actually shrunk as a company last year when you compare it to real dollar value. So I actually think there is a risk in holding Bell and that its company value is actually going down. And then, and to be fair, I owned Bell for a period of time. I swung traded, but like I bought it when it's cheap and I sold it when it reverted to its mean because I was not going to hold that company for the long term. And like, look at Algonquin Power. Like Algonquin Power is such a darling of like the value investing community in Canada. Like whenever you're in a value investing group in Canadian,
well, I have some, yeah.
everyone always brings up Algonquin Power, and like analysts are predicting a negative growth rate for its earnings, and its PE is similar to Facebook, and it pays a dividend, and like it has a ton of debt. Like you ask me, what would I rather own? Facebook, a company that has proven execution strategy, that has a really high moat, which has 3 billion users worldwide, or like some rinky-dinky power company in Canada that I'm not positive has a positive growth rate in the future. Like, it's a no question. It's a no-brainer for me. Like, I'd rather own Facebook, and like they're selling at cheaper or a relatively similar value.
It's a very different business, you just have to say.
The optionality of the cash too. They've got a huge cash pile with not really much debt or obligations. Like the optionality on that is huge.
I know Nate's got to run. I just want to get a quick because your take. So basically, the question is basically what percentage of success do you give Facebook in Zuckerberg pulling off the metaverse play?
Oh, I'm pretty bearish on the Meta thing because one, it's not a real product yet. Two, it doesn't actually look cool to me. Like as a person, like I can't imagine myself giving a crap about the Metaverse. It looks super gimmicky to me when I look at the ads for like that Mark Zuckerberg created. And just because he's like first to like one of the first people involved in making the metaverse, doesn't like excite me because it doesn't mean that he actually like takes profit from it.
Well, I see that as more of a recruiting campaign, right? He's trying to attract people who want to share that vision to go work for Facebook. They talked about like increasing the headcount a lot in the last call.
Yeah, and but my point is more that even if the metaverse doesn't succeed, Facebook is still a good company. It's still undervalued.
But that's the thing. That's the thing. The cash is gonna keep going to Reality Labs, whether you like it or not, right? So but like, you better pull it off.
But I think what he's saying is even if that cash does disappear and you sink $5 billion a year into it for the next 10 years and it comes out as nothing, Facebook is still a beast.
But I think it'll be more. I think you're
right.
This bet is heavy.
But
he's grudge with Apple is personal.
Yeah, but he's also like investing in other things too, like the Oculus, and like the Oculus looks like it's really going to take off. Like I'm a school teacher, so I get to talk to kids all the time, and I actually think they're a really good like market test group. They all want an Oculus Rift. They don't care about Xbox. They don't care about like Nintendo. That's what they want, and I think that's a really good sign. And so do I think he's going to execute on that? Probably not, but like I think there's a chance he does. And like I don't tend to look at things like that's very much like a classical like value investor look. I tend to look at things like what is the valuation of the company at that moment of time, the end of the 10 years, and is it going to be worth it to me? Like, do I want to own a company that might, if Facebook's market cap didn't change at all over the next 10 years and it's down to like a PE of 5 or something, and it's still got 3 billion users and it's still making like piles and piles of cash, do I want to own that business? Yes, I do. So that's the way I tend to look at it. And maybe I'm wrong. I'm not a professional investor. I'm an amateur. I'm a school teacher.
Yeah. Tom, what do you think?
I think that what I see more value in the future is the AR. The augmented reality, I think, is going to be bigger, especially, it was almost a year ago on the conference call when they were talking about the partnership with Ray-Ban that's just dropped the product right now. And they were talking about the difficulty of fitting a supercomputer into a normal looking pair of glasses. And I think that in the future, our devices aren't going to be phones anymore. Like imagine if you can have a regular pair of glasses and you can have all the access and functionality of your phone.
Yep.
Right.
Yeah. I just come from a perspective like years ago, I've seen some of the company document, emails from Zuckerberg leaked out. He just sounds like a really good execution. He has a unique take to management, how to increase productivity. Say what you will about his ethics. And I agree, from the Buffett angle, that you want people who, really want to treat the investors fairly. But I prefer to invest with a visionary, and I think, Zuckerberg is a borderline visionary.
I agree with that.
Because like at this point, with the amount of money he has, like it's not like for a lot of these bigger, like, Musk, Zuckerberg, like once you get to a certain amount of money, like and wealth, it's not about the money anymore.
Yeah, you need to have
it's about the legacy and the goal of pursuing something that you find meaningful and that you think is going to be something really big. Because all of these people, they could just sit on a pile of cash and do nothing.
Well,
like,
then what's the Google really founders, they run out of mojo, right? Basically, right? So out of the famous stock is really Musk and Zuckerberg and Reed Hastings. Although I don't really know what the grand vision Reed Hastings has for Netflix, but Microsoft, Google, and Apple, they've all moved on, right?
Yeah. And I part of that, how I look at it is if Zuckerberg wanted, he could probably put a 10% dividend on tomorrow, which would be crazy, and the stock price would go up for sure. It would, but he's not doing that. He's making a long-term bet on the company that he can grow the revenue stream over time, and because he's executed on that past, I'm willing to ride some of my money on that and let it go. Although, admittedly, I'm not telling anyone to be like, you should go put out a ton of money on this. Like personally, I have like 5%, no, maybe, I don't know, 8% of my net worth riding on Facebook, but like, it's nothing I'm not willing to lose.
Yeah,
awesome.
I think a good risk management strategy in any portfolio is good, because there's always the chance that we're going to be wrong.
Yeah, 100%.
Like
I'm currently down 45% on Facebook, and I'm still buying. But yeah. Anyways, I got to run, guys. It's been fun.
All right, we'll come out with a stock to talk about next week on the chat.
Yeah.
Bye, guys.
All right. Great talks, guys.